Welcome to the Deep Dive. We're here to translate those complex financial reports into insights that are, well, clear, maybe even surprising, and definitely actionable for you. Today, we're tackling Oyak Cimento Fabbricalari Anonim Şirketi. Oyakis, for short.
That's right. And our mission is to really get under the hood of their consolidated financials for the first 9 months of 2025. We'll be comparing them against the same stretch in 2024. But this isn't your standard comparison. We need to be really clear about that. Turkey's high inflation means these figures are prepared under TMS 29.
TMS 29. Okay, for anyone not familiar, what does that actually mean for how we read these numbers?
It means every single figure, every lira we talk about today is adjusted for inflation. It's all stated in the purchasing power of the lira as of September 30, 2025. So we're comparing real performance, constant prices, absolutely vital for seeing if they're actually growing or shrinking operationally in this kind of environment. If you're looking for a shortcut to grasp this specialized data, you're definitely in the right place. Maybe share it if you find it useful.
Good point. Okay, let's start with the company itself. Who is OYAKC? Because they're not just some small regional player. Right?
Oh, definitely not. They're a giant in the Turkish market. Their registered address is Ankara, but that doesn't tell the whole story. OYAKC today is really a result of consolidating some major cement producers. Think Mardin, Aslan, Adana, Bolu, Ünye, Denizli Cimento. It's a powerhouse in terms of production capacity.
And their main business. Pretty straightforward.
Very much so. The segment reports confirm it loud and clear. Cement and ready-mix concrete. That's Cimento Vehezur Beton. They also have operations beyond Turkey subsidiaries in northern Cyprus and Romania, mostly focused on sales, trading, and some port operations too.
Right, and ownership that's shifted a bit, hasn't it?
It has, and it's crucial context. The lion's share, just over 80%, 80.05% to be exact, is now held by TCC Oyak Amsterdam Holdings BV. This happened through share transfers earlier in 2024. So the ultimate parents are Taylan Cement Corporation, TCC, and the Turkish Armed Forces Pension Fund, Oyak. The remaining slice, just under 20%, is what's publicly traded.
Okay, and what about the people running the show? How big is the workforce?
They're growing slightly there. Employee count went up from about 3,083 at the end of 2024 to 3,274 by the end of September 2025. But there's a number related to management that really jumped out at me. We should probably highlight this early.
I think I know what you're referring to. The compensation for top management, it looked significant.
Significant is maybe an understatement. Even after we account for inflation across those 9 months, the total compensation package for the top executives exploded. We're talking 419.8 million Turkish lira in the first 9 months of 2025. Compare that to 119.0 million lira in the same period of 2024. It's a huge leap.
Wow. Okay, that's a massive increase. Any context given for that? And while we're on governance, any word on diversity at the top?
No specific context provided for the jump in the notes, just the raw number comparison. And no, the reports don't provide any breakdown on, say, the percentage of female board members or executives. That data isn't disclosed there.
Right. Well, that huge compensation figure immediately makes you wonder about cost control, especially when we start looking at the operational side. Did the performance justify that kind of spending? Let's get into the numbers. Revenue first, Hasılat.
Okay, so looking at the top line, Hasılat, we actually see a slight dip overall in real terms. It went from 41.7 billion TL in the first 9 months of 2024 down to 40.5 billion TL for the same period in 2025.
So it's slightly down. Is that across the board, or is there a specific area driving that? Feels like the domestic market might be the story.
You nailed it. The overall decrease is almost entirely due to softening demand in the domestic Turkish market. What's interesting, though, is that their foreign sales, their exports held up remarkably well. They were almost flat year over year, around 2.9 billion lira. That export stability is pretty crucial for them right now.
Okay, so domestic weakness offset partly by steady exports. Since revenue slipped, I assume gross profit, brut car, also took a hit.
It did. Gross profit fell from 11.62 billion TL down to 10.76 billion TL. But digging into the segments really shows where the pressure points are.
All right, let's break that down. Cement versus ready-mix.
Exactly. The main cement segment, their core business, saw its revenue drop from about 27.9 billion down to 25.5 billion TL. And that pulled its segment profit down quite a bit too, from 9.6 billion to 8.1 billion TL. So yeah, clear signs of slower domestic activity or maybe some volume loss impacting the main engine.
Okay, that makes sense given the overall trend. But the ready-mix concrete side has our baton that showed something different, didn't it? Revenue actually went up there.
It did, yeah. Revenue for ready-mix increased year over year from 13.7 billion TL to 15.0 billion TL, so they sold more. or perhaps manage higher prices in real terms.
More revenue. But what happened to the profit in that segment?
Well, this is where it gets quite concerning. The core operating profit for Ready Mix basically evaporated. It plunged from 680.7 million TL in 9M 2024 down to just 252.0 million TL in 9M 2025.
Wait, hang on. Ready mix revenue is up, but the profit just collapsed. That screams margin destruction. What's going on there? Input costs,
Yeah.
energy.
That's exactly what it suggests. Things like energy, transport, maybe specific raw materials for Ready Mix. The cost must have spiked so aggressively, even after inflation adjustment, that they just couldn't pass it all on. They pushed more volume or achieved higher real prices, maybe, but costs ran way ahead faster than they could adjust pricing. It's a definite red flag for cost management in that particular segment.
Okay, so summing up the operations. Core performance weakened significantly overall. The main operating profit figure, Isas Faliet Kari, confirms this, right? Down from 10.36 billion to 8.37 billion TL.
Correct. That's the overall operational picture, weaker year over year.
And this is the puzzle. Despite that weaker core operational profit, the final period net profit, the Donem net Korea, actually went up slightly from 7.10 billion to 7.28 billion TL. How did they manage that? How do you get higher net profit with lower operating profit?
Yes, the paradox. To solve this, we absolutely have to look below the operating line. We need to look at the financial items and, critically, taxes. Now, finance expenses did increase quite a bit. They almost doubled, actually, from 1.11 billion to 2.09 billion TL. Reflects higher debt, higher financing costs in this inflationary climate.
Okay, so finance costs were a headwind too, but something else must have more than offset that. You mentioned taxes.
Taxes, that's the key. The total tax expense was effectively cut in half.
Halved, really.
Plummeted from 3.38 billion TL in 9M 2024 down to just 1.56 billion TL in 9M 2025. And the reason? It's spelled out in the notes, specifically Note 40. They made very effective use of tax benefits available under Turkey's investment incentive system. They realized a benefit of about 850.9 million TL just in these 9 months.
Wow, so that massive tax break is what bridged the gap. It basically canceled out the weaker operating performance and the higher finance costs to nudge the net profit slightly higher.
Precisely. It was a strategic financial move linked to their investment activities that stabilized the bottom line. It wasn't driven by better sales or operational efficiency in this period.
That really reframes the net profit figure. It's crucial context. Okay, so let's connect this to the balance sheet. How is the company's financial health looking, especially considering these big investments they seem to be making? Liquidity first.
Well, liquidity looks surprisingly strong on the surface. Cash and cash equivalents saw huge growth. They jumped from 7.9 billion TL at the end of 2024 up to 13.9 billion TL by September 30, 2025. That's a very healthy cash pile.
Nearly doubled cash. Okay, but what about the other side? Debt. Borsuluk.
Yeah.
Because those investment incentives usually come with, well, investments, which often means borrowing.
Good point. Yes, their total bank debt did climb noticeably. It reached 3.7 billion TL. And a big chunk of that increase came from new euro-denominated financing they took on early in 2025.
Euro debt, was that for general purposes or something specific?
Very specific and directly linked to what we were just talking about. They secured 75 million specifically for major capital expenditure projects, the CapEx. This money is earmarked for 2 key areas aimed at tackling those cost pressures we saw. A huge 115 megawatt solar power plant, a GES plan for Ankara Beypazarı, and installing waste heat recovery systems at their Ankara, Adana, and Mardin cement plants.
Ah, okay, so they're borrowing strategically to invest heavily in energy efficiency and self-generation, trying to attack that cost base directly. Makes sense.
Exactly. These aren't just maintenance investments. They're potentially transformative for their cost structure if they execute well. Vital for reducing exposure to volatile energy prices, which, as we saw, seem to be really hurting margins, especially in ready mix.
Right. And speaking of managing costs and cash, what about working capital? How are they managing payments to suppliers versus collecting from customers?
That's another interesting area. Their average collection period from customers, their trade receivables, held pretty steady at around 47 days. So they're collecting cash at about the same pace. But on the other side, they've managed to stretch out how long they take to pay their own suppliers. The trade payables term lengthened quite a bit, from 72 days up to 86 days.
So collecting in 47 days, paying in 86, that's a positive cash conversion cycle improvement, isn't it? holding on to cash longer.
Yes, it definitely helps their working capital management. They're effectively using their size and leverage with suppliers to optimize cash flow within the operating cycle.
Okay, good operational management there. No, before we wrap up the financials, you mentioned footnotes being key. Is there anything else buried in there that investors really need to pay attention to? You mentioned related parties earlier.
Yes, absolutely. The related party transactions footnote is critical, particularly regarding cash. It reveals a lot about where the company's cash might be heading. There are significant transactions with other Oyak Group companies buying fuel, bags, steel, things like that. That's somewhat expected. But the really telling part is under other short-term liabilities. There's a huge chunk, 5.6 billion TL, owed to related parties. And the note breaks it down further. 3.89 billion lira of that isn't commercial debt. It's explicitly labeled as outstanding dividends payable to the main shareholder, TCC Oyak Amsterdam Holdings BV.
So nearly 4 billion lira of their liabilities is actually declared dividends they haven't paid out yet to the parent company.
Exactly. This isn't money tied up in operations or typical supplier debt. It's cash that's essentially been earmarked and is legally owed to the majority owner. It gives you a much clearer picture of the distributable cash versus the total cash sitting on the balance sheet. It signals a very large cash transfer is pending.
That's a crucial insight. It definitely changes how you might interpret that big jump in their cash balance.
Okay, so let's try and connect all these dots. What's the overall story for OYKC in these first 9 months of 2025?
Well, in a nutshell, OYAKC clearly faced headwinds in its core operations. Profitability weakened, particularly in the ready-mix segment where margins got absolutely crushed. However, the bottom line, the net profit, was skillfully shielded and even slightly improved. This wasn't due to operations improving, but almost entirely thanks to non-operational factors, specifically that very large tax benefit from leveraging investment incentives. And we shouldn't forget the stability provided by their export revenues, which was a key operational positive. So, a story of operational pressure being masked, to some extent, by savvy financial management and tax planning. They've bought themselves time, perhaps, but the underlying operational challenges, especially on the cost side, are real. They're making huge bets now on this energy capex, the solar plant, the waste heat recovery. It seems like the sustainability of their profitability really hinges on how quickly those investments start paying off in terms of real operational savings.
Absolutely. The focus really shifts now from just sales to, well, engineering and project execution. Can they bring these large, complex energy projects online efficiently and start seeing those cost benefits flow through? That's the big question. The true test will be if these investments allow them to regain some pricing power or at least defend margins better against ongoing inflation in that tough construction market. Can operational cash flows stay ahead of the debt they took on for these projects?
A critical period ahead for them, then. From financial maneuvering to operational execution. If you found these kinds of objective, deep insights helpful for navigating your investment decisions, please do make sure you follow us. That way, you won't miss our next analysis. Thanks for joining us today to unpack this complex set of results.